Jay, it's always good to see you. I think front and center as we head toward the end of the year, people are worried about the economy. And I was curious, and I think others might share this. We're starting to get a lot of data that is dated because of the shutdown. So we're catching up with these data inputs, but are they reliable? Are they really telling us anything as we head toward the end of the year?
Thanks, Adam. It's great to be on. Well, you sort of have two cross currents. The first is that particularly with the labor data and inflation data prepared by the BLS, in the case of the labor data, it's initially very inaccurate because they don't get all the returns of they use the mail, which is a great technology from the 1970s. And so they don't get them all returned. So they typically get revised heavily. Now it's even worse because they weren't even at work. So the data is both delayed and dirty, probably dirtier than normal, or inaccurate is probably a better word. And then the inflation data doesn't have that survey problem, but it is delayed by 2 years because they do calculate shelter that, first of all, they just delay it on purpose for 6 months, which is totally insane, but true. And then they also use renewing rents, which delays it another 1.5 years. So it is a huge issue. Thankfully, it seems like the Fed's going to be able to see through that flawed data and make their own estimates on the labor market being weak and still cut this month, notwithstanding some indications to the contrary. And that is important because, as you mentioned, the economy is weakening. It's a little bit hard to see because the old economy is very weak. Construction, housing are in recession. Tech and the inputs to tech, like power and data centers, are very strong, and also just chip manufacturing. So you really have a tale of two cities, but it's critical the Fed cuts, and then we'll get back to normal growth next year.
We just interviewed Carol Roth, who talked about the K-shaped economy, how those who have investments and asset prices keep going up. But I'll use this term, the old economy, we may not be seeing the hardship that is occurring in the old economy. And the data we're getting wouldn't really seem to give me as an investor an accurate understanding of what's been happening in the past. If that's an accurate statement, how do I position myself for 2026?
Mm-hmm. Well, there's a dynamic that a lot of people haven't focused on, which is, so the Fed debased the currency. So they increased the money supply, and this is why we typically are much more accurate than most people, because we think the money supply matters, the Fed does not. So when they increased the money supply 70%, we knew there would be inflation. And in fact, that's the only thing that makes sense, because otherwise we wouldn't have to pay taxes. You could just, put out more currency and pay for everything. So the money supply went up 60% net, 38% increase in GDP nominal, and a 22% increase in the price level. But so if you think about that, most of people's expenses are rent. So if you own your own home, it was great because you have fixed costs. You probably have a fixed mortgage that might have been paid low because you refinanced. Much higher prices for your house. You don't have to sell it, but you can borrow against it. But if you're renting, so this is the bottom of the K, it's unlikely your wages kept up with the rents. So that's why you have a lot of unhappy people, a lot of discussion from the right and left about affordability. But we don't think that puts the economy at risk, because really there's been there's never been a recession precipitated by a weak consumer. The reason for that is that low-income consumers have to consume because they just have to buy food and shelter. They have no choice. And high-income consumers want to consume, and of course they have the income to consume and the assets. So you see very stable in the last 13 post-World War II recessions. The net decline in consumer spending was 0%, but the net decline in investment was 10%. So that's why when we say construction and housing and recession, we're talking about the investment part of that. So that's a key insight. Is if you're trying to call the economy, don't really focus on the consumer, focus on investment, because that leads us down. Consumers, even if they're under pressure, they're still going to consume, even the low-income consumers.
So as I look forward, and I'm going to ask you something about copper in a second, but as I look forward, what I think I just heard you say then is, as an investor, I should be careful because we do have this housing shortage, but I think you just said we're seeing a pullback in construction. Did I miss something?
Yes, absolutely. The shortage is actually good news for cyclicality of the economy, and we have something on our website that shows this. Because of the great financial crisis, we never really had a boom in housing construction. And we did have pretty good population growth, partly from immigration. So when I was a kid, there was this huge housing boom and bust. 2.3 million homes were built in the late 70s. In this cycle, the highest amount of construction was 1.7 million homes. Now we're down to 1.3. Normally below 1.1, that's a recession. So it's actually good news, and the economy's become less cyclical. And if you don't live in the New York metropolitan area, actually rents are pretty under control. So good that we never had the boom. We do have a shortage of housing, but actually rents are pretty under control because there was a lot of apartments built. But something that needs to be watched, because if the Fed didn't cut rates and mortgage rates stayed above 7, you'd have construction go, well below 1.1 million, a ton of layoffs. And consumers do consume less when they get laid off.
So let me ask you about copper. And this is just, this is me pulling at straws because the way my brain works, it's permanent ADD. But there's this metric that I used to hear a lot when I was at Yahoo, Dr. Copper, meaning, copper can tell you the health of the U.S. economy. What in the past, if there was high copper demand and copper futures were higher, it meant people were building houses. That's a Luddite's explanation. But today we have the hyperscalers, huge amounts of building taking place, and that's creating a demand for copper. So would that mean that Dr. Copper as a metric to determine the health of the economy moving forward is no longer reliable?
Well, it is actually working because copper prices are quite strong. In fact, we own Freeport-McMoRan in our ICAP, our large cap dividend fund, because they're benefiting from tariffs, copper tariffs, but also from strong demand. So the reason that copper did work extraordinarily well is that copper is a big input into housing. So it basically was predicting the decline in housing, or at least correlated with the decline in housing. And so, but it's still working as an indicator because that decline in housing is being offset by construction of data centers and chip factories and power plants that power that. So it's still working, but just working in a different way, where the housing part of copper demand is very weak, but the really tech-driven demand for copper is very strong. The net of that's still positive. And that's why we're really very, very unlikely, particularly now that the Fed looks like they're going to cut again, is on a cutting cycle. Chance of recession, we actually don't like probabilities, but we're saying there's definitely not going to be a probability, and they're going to have 3% growth next year when housing starts to recover because of lower rates and you get this ongoing tech build out.
So let me ask you as I wrap up, looking at 2026, if we're looking at 3% growth and we're going to have a tech build out, and there's a colleague of yours, Dan Ives, he keeps saying, look, tech is not a bubble. He put out a note just this morning, this is not a bubble. What do you think? What would you say if I were a client looking at 2026 as to what I should be expecting?
Well, I would be bullish. We have a 7,900 target, so that implies well over 10% upside to the market. And the way to address the tech bubble issue is to look for the whole S&P, is to look at the Mag 8, so that includes Broadcom. That gets you 40% of the S&P. And then we use GARP models, so reasonable growth to PE. So the PEG ratio of all those companies is right in line with the market. It's about 2 times. So they're fairly valued. They're actually getting a little bit cheap now because the market's pulled back. There are parts of the market that are in a bubble. So arguably, well, not even arguably, but crypto crypto treasury companies, some private companies, maybe OpenAI is trading at 25 times revenue. It's not really trading, but it's raising money at 25 times revenue. So a lot of money losing companies, highly speculative companies have come off dramatically. So that part of the market was a bubble, but it's not significant to the market as a whole. And hopefully conservative investors are not in those sectors. So we're highly constructive, not bubble, but therein lies an opportunity. Probably the Mag 8 will end up in a quote bubble, or at least significantly overvalued at some point over the next 3 or 4 years. So ask yourself the question, do I want to be invested now, benefit from the bubble, and then hopefully trim or get out, or sit on the sidelines and keep yelling that there's a bubble for 3 or 4 years and miss out on the returns?